And we're live. Hey, Carley, how's it going?
Hey, good. Thanks for having me. It's fun to be here.
Awesome. Yeah, really stoked to have you on. As we were just kind of talking about, I'm really excited to get your expertise to the audience that I deal with frequently, and a lot of folks are interested in futures. It's a bit weird, and a lot of folks have a hard time breaking from, especially going from equities to options, let alone from options
Right.
to futures or something like that. So really excited
Perfect.
to, hear how you went about it. So do you mind sharing a little bit about your background with the
Sure.
futures market and how you got into trading?
No problem. So I'm in the brokerage industry. So we offer we're basically a boutique brokerage service is what we are, and we offer trading in futures and options on futures. Where we're different than most of the other brokers that the bigger name brokers that everybody's heard about, is we only deal in commodities. We don't deal in stocks or bonds or anything like that. Just futures and options. So we specialize in them. Because of that, we tend to be better equipped to offer those products. We offer more products, more option expirations, exchange minimum margins, those sorts of things. And I got into this business honestly by just dumb luck in college. I started out as an accounting major, and I realized halfway through, man, wow, this is boring. This is not for me.
Yep.
But I finished it anyway, and then I went back and also got a second degree in finance. And my original plan was to be a stockbroker, but I did an internship for quite a while, for several months, and I realized that really wasn't for me either. It was a lot of selling of, it was basically selling. I was a
Got it.
salesman of loaded mutual funds, and
Mm,
it didn't excite me. And I felt like I wasn't offering any kind of service. I was just selling something to somebody they probably could do on their own, as far as just finding a fund that works for them. So anyway, to make a long story short, I stumbled across a commodity brokerage here in town, decided to give it a shot, and I've loved it from day one. So
that's kind of fascinating that you
yeah.
made that jump that directly. So did you have
Right.
any trading experience before you made it over to the broker, or how did that
No,
work?
none, not at all. I mean, I knew I had taken, and this is the most ironic thing also. I went to UNLV, and at UNLV, I did get my finance degree, but I specialized in equities and portfolio management, as
Oh,
well
that's
as
funny.
real estate. And they had a futures and options class, and I'm like, I don't need that. I'm not even going to take that, because you can pick some of your electives
Right.
within your major. And so anyway, I didn't even bother to take it in college. And then first thing out of college, that's what I ended up doing. So it was kind of
That's
interesting.
that.
Yeah.
Yeah, that's actually pretty awesome. When I was doing my MBA, I took a couple derivatives courses, and I'll be honest, I don't think you missed anything because the courses I took were just horribly outdated for
Yeah.
what we were seeing. So that's actually a
Well, you know what I've actually learned from after the fact, like just talking to other people that did take those classes and
Mhm.
looking over the textbooks, honestly, most of the things they're learning in those classes, they're probably things that are good to know, but they're wouldn't have helped me whatsoever in my
Right.
career. So I'm not worried about it.
Yeah, I know a lot of education seems to be focused on
Yeah.
theoretical and not necessarily
Right.
practical.
Reality. Yep. And you're
Yeah.
exactly right.
So as you know, we get a bunch of questions in and love to run through some of those. Before we get into the handful of questions, the first thing I would love to start with is just what's your current assessment of the current marketplace? Obviously, a lot of folks feel a lot of different ways about it, including myself. I go back and forth in terms of, where I see risk and whatnot. I'd love to get your thoughts on
Sure.
just the current state of the markets.
So we're seeing some really interesting dynamics
Mm,
with Fed money printing, and we've all read about the Fed money printing and what it does. And I do recall, I've been around for a while. I would live through the 2008 fiasco, and I
mhm,
do remember quantitative easing and what it did to the markets. And it
right.
basically triggered a never-ending bull market. Now the circumstances we're in right now are a little different in equities, because we started out from an already elevated level, and back in 2009 we were basically in I mean, we were in the dumps. So
Yeah.
it's a little bit different, but the end game is the same. Money flows into the markets, it needs a home, and so equities so far have been the winner. And we've also seen gold and silver make moves, and I think eventually the other commodities will follow, just because that's what happens when money is pumped into the system. I do think at this particular time, though, we're seeing stocks are overpriced and commodities are a little underpriced, and that will probably correct itself.
Do you think what do you think about the current
Excuse
price of
me.
gold and silver where they're currently at?
I tend to be bearish gold and silver. I think that they've
Sure.
both seen their highs. They're boom and bust markets,
Hmm.
and they always sucker everybody out in at the highs. And then, I mean, we saw this in 2011. They've spent 9 years wallowing, and so I wouldn't be shocked to see something like that, to be honest.
Yeah, it's actually funny. I put a video out not too long ago when gold had that 30-point drop or whatever on the
Mhm.
11th. I ended up fading that move, just seeing it come back down below the 2000 level, and I just thought that I don't know. I think gold above
Sure,
2000 is extended for sure.
I agree with you.
Yeah. Cool. So that's my personal question. To get into a handful of the submitted questions, the first one is, why do you think short options is viable for equities, yet must be avoided for futures options?
So I can't speak to equities. That's just outside of my, I mean, I just don't do stock options. I'm not
Sure.
licensed to talk about that. But with that said, if you would have asked me a similar question 2 or 3 years ago about selling options and commodities, I would have said, I prefer naked option selling. I think it's the way to go. There's all kinds of arguments for and against.
Hmm.
But what I've learned in the last couple of years, the markets have changed. And therefore, my view on that has changed with the algo trading and all the other things that we have going on, and just really retail traders having more access to the markets. Trends seem to be overextended more so now than they used to be. So if you're an option seller and you get caught on the wrong side of a move, you're really in big trouble.
Yeah.
More so now than would have been several years ago. So I think at this point, I've kind of adopted the mindset of naked option selling is just not the way to go, at least for now. I think anytime, I still like the idea of selling options to finance trades. So like
Right.
as part of a spread. And if you're going to be a premium collector, that's fine too. But I think you have to have some sort of insurance in place, because it just so happens that in the last couple of years, anything that could have possibly gone wrong for option sellers went wrong. And so if you didn't have insurance in place, it was a really tough game.
Yeah, I think that's a really fair point. And something that I talk a lot about is because I typically sell premium both
Mm.
in options for equities as well as options on futures. And the thing for me is, if I'm, fading a move that I think is overextended, like gold, for example, I would
Right.
never have any sort of long-term position to the short side in there unless it was covered or unless I had a tight control
Sure.
over it for that exact reason.
Yeah.
And it's interesting that you brought that up, because I do think that the moves that we've been seeing over the past 2 years or so with
Hmm.
stuff like gold, like right now I have a chart up 6 month, and almost 6 months ago it was at 1450, and then it blew up to essentially 2090 over the, what I
Right.
mean, like, just it's
Right.
exactly what.
It's totally insane, the pace at, and what's
Yeah.
even worse is it's one thing to be short the futures during that move, but to be short call options is actually even worse, because
Right.
the extrinsic value of the options just completely explodes. Deep out of the money options were, I mean, quadrupling in price in a couple of hours. I mean, just insanity. And we even had some clients that were selling uh, naked strangles. And what would happen is the option market was so broke that as the market went up, the call options were gaining in value, but the
Yep.
puts weren't losing. So like the idea of the strangle is, they're
Yeah.
supposed to be hedged, but it wasn't working like that, because the puts were actually gaining value as the market went up,
Oh,
because the volatility was so intense. So it was
yeah.
just, yeah. So not pretty for sure, not
Yeah,
fun
and it
either.
kind of goes back to what you were saying just a little while ago about everything going wrong that could, because that
Right.
that is, worst case scenario, essentially, if
Right.
volatility expands while it's moving against you.
Sure. Yeah.
Um, so another great question that we were just talking about is, why do you think we haven't seen a pullback despite all the indications of market uneasiness? And they say hesitant to say weakness, which I guess I kind of
Mhm.
understand why. And they said our current bull market is incredibly fragile, and wondering if there's a good reason why it hasn't crumbled. What do you think?
I mean, in addition to what we've already talked about, the Fed money printing, that's
Mhm.
one reason. But honestly, I think a big catalyst for this rally has been the bears themselves. Everybody's so eager to sell into this market that it's just been like a never-ending short squeeze. The market will sell
Yeah.
off a little bit, everybody gets excited, goes short, and then it squeezes higher when nothing happens. Um, I mean, if you look, this rally feels really, really crazy if you're looking at a daily chart. If you look at a monthly chart, honestly, it's not that out of line. We back in March, believe it or not, we were saying, hey, listen, this rally could see 3,500, 3,600. I actually got like mean tweets because people thought that was just like so insane. And I got to admit, at the time, I've wondered if I was a little insane by even saying that out loud. But if you look at a monthly chart, we've been in this pattern. It's like a megaphone pattern of volatility where the market goes from excessive, speculation, exuberance, basically,
Hmm.
to panic, and then back and forth. And so we're right on schedule here. 3550 to 3600 is right at the top of that trading range. So with that said, from here, I do have to get really skeptical because it did happen a little sooner than we thought. We were thinking like year end, not
Right.
September, October. So this has definitely been a wild move. But why it hasn't cracked? I mean, there's probably not a real valid answer to that, other than we're probably getting close to a pretty good sized correction, is my guess. I don't think the rally is completely over. I think with the election and some of the things we have coming up, I think it's time for a pause, and it could be a real quick pause. If you remember in June, the correction was roughly, in the S&P anyway, was roughly 300 points, and it
Hmm.
happened in 3 days. So 3.5 days on the futures. So I wouldn't be shocked to see something like that. It would be real quick and scary, but that's probably all we're going to get, at least until we get beyond the election and see what happens there.
It's interesting that you bring that up, especially the money printing. Essentially, I was reading the minutes from the last FOMC meeting, and I found it interesting that they were talking about the kind of marginal benefit of keeping interest rates where they were, whereas previously they were pretty like set on maintaining really low rates. I'm curious, what they're going to be doing with that going forward, because I do think that that has been a pretty significant driver for folks, flooding money into the
Sure.
market. Just curious, do you have any thoughts on that?
I mean, obviously, low interest rates is good for the market. Another thing to keep in mind also is the interest rate policy is influencing the currency markets, and we tend to
Yeah.
forget about currencies, but as the dollar has been weakening over the last month or so, that is also buoying stocks up, and that's just how it works. So if we do see a little bit of a correction in currencies, which I think we might, I think the euro's a little overdone,
Hmm.
and the dollar is probably due for a bounce. If that happens, that'll put a little pressure on stocks as well, at least short run.
Yeah, yeah. That I think that's a good tie-in. And speaking of rates, the next question is: do you anticipate the 10-year note retesting the low yield of 0.5%?
I don't anticipate that occurring, but I would love to see it because I do think treasuries are probably putting in a long-term high. If you take a step back and look at a monthly chart of the 10-year note futures or even TLT if you're trading stocks, it's really incredible the readings we're seeing. Like for example, RSI, we've only seen this type of an RSI reading on a monthly chart maybe 3 times in the last couple of decades,
That's
and
interesting.
each of the other times the market's collapsed eventually. It's easy to look at a monthly chart and think it's obvious, but when you're looking at a daily chart, it doesn't seem quite as obvious. So it's something that you need to take a step back and look at. I'm not saying we can't retest the highs or the low yields because the prices are inverse, but I doubt we will. However, I would like to see, seasonally the market tends to top out right around now. So I would love to
Right.
see a little, like basically a return to the highs of a few weeks ago, or the low yields of a few weeks ago. I think it'd be a great place for anyone that's bearish to get in on a low risk trade, but we'll see if that happens. But uh, my personal view is any rally in treasuries is probably a place to get bearish,
Yeah,
looking for higher yields.
I definitely agree with that. Now, dovetail off of that question, do you have a preference between monitoring the 10-year versus 20 or 30-year, anything like that, or do you kind of like to look at all of the yields?
Well, I mean, I look at everything across the board, but I probably pay most attention to the 10-year note, and the only reason being, as a futures trader or as a futures brokerage, that's where most of the trading action occurs.
Right.
The 30-year bond used to be where most of the action occurred, but
Right.
it's gotten, the duration is so long on the way that the basket of bonds that it represents on the futures side of things, that it's really just a high risk contract. And so a lot of people
Interesting.
prefer the 10-year note. It's a little tamer, it's more liquid, the options are cheaper. So for us, that's where we focus. But we also look at you've maybe even never heard of this product. It's called the euro dollar.
Yeah.
It's not the currency. Okay. The interest rate. Most people, when I
Hmm.
say that, most people assume it's the currency,
The
but
currency. Yeah.
we love watching the euro dollar market because it's basically the easiest way to think about it is it's a T-bill. It's like a 3-month interest rate vehicle. It's extremely liquid. In fact, it's the most liquid futures market in the world, even though most people haven't heard of it, which is ironic.
Yeah, that is pretty
But
funny.
it's a really, really great way, especially for beginning traders, because the margin's low, the risk is low. You can hedge your futures with options. So it's a really great place to be.
That's awesome. I'm glad you bring that up. I'd probably like to pick your brain on that in a minute. Another question, just following off of that, do you think that the focus on shorter term bonds changes as rates increase, or do you kind of think that the 10-year and shorter term will be the new thing going forward into perpetuity?
Well, given the policy that we're seeing unfold, it seems like the short end of the curve is going to be so highly influenced by the Fed that there's not going to be
Mm,
a tremendous amount of volatility there. Things can change. I mean, we've learned that. If you remember, at the end of 2008, the Fed was raising interest rates, and at that time, the Fed had basically stated they were going to be raising rates for the next 2 years, and they had their schedule. And
yeah,
honestly, we've done the exact, it flipped on a dime, and we haven't looked back since. So just because now the Fed is talking about keeping rates this low for years and years doesn't necessarily mean that's what's going to happen. Things can
right.
change really quickly. If the economy comes roaring back, they will rethink that, just like they did in 2018 on the other side of things. So for now, I'd say the short end of the curve is probably going to be pretty dead. But 10-year note's a good place to be because the 10-year note, it's influenced by what the Fed does, but it's not controlled by what the Fed does. Because I
Right.
can guarantee you eventually investors are going to start looking at their portfolio and they're going to look and see that they're making nothing on the 10-year notes
Yeah.
they're holding, but they have duration risk. I mean, let's face it, if interest rates do swap and you're holding 10-year notes or 30-year bonds or whatever it is, you're in trouble.
Right.
So in my opinion, eventually they're going to start looking at that, and that'll, that should put some pressure on the market. Who knows
Yeah.
when? If only I knew when and where, but
Sure.
it will eventually.
Yeah. And then, so one more question on bonds and notes. I was reading about the, Fed's process for buying bonds, and they're using ETFs and for a lot of it. And a lot of folks were kind of talking about the issue with that because a lot of times when the Fed would buy, straight bonds, that would help with market liquidity.
Right.
And folks are saying that with them buying ETFs, that has the potential to widen, the bonds that the ETFs are tracking. Curious if there's any carryover of that to the futures market, or if it's just,
Um,
non-factor.
that's probably not a huge factor in
I figured.
futures and what we do, but with that said, I do have to applaud the Fed for stepping in and buying corporate bonds,
Yeah.
ETFs, and outright. Even though, I mean, there's all kinds of arguments that, against what's fair and what's not fair. They're picking and choosing winners, and I get that. But I do remember 2008, and one of the big issues with the stock market was people would look at the credit spreads or the corporate bond market and see everything trading at massive discounts, and they would
Right.
scare them, and they'd sell stocks, and then they'd look. So it was like literally this big cycle of people scaring themselves,
Right.
and it just never ended. And so I think that was one of the reasons, like, people were so shocked that the stock market rebounded as quickly as it did this time around. And I think that was a really big part of it, is you can look and see that your corporate bonds aren't completely crashing. And it
Right.
just made people a little more comfortable, and I think it stabilized the market much quicker.
Yeah, I couldn't agree more with you. When I was looking at the drop, I like to compare different drops throughout history, bear markets and whatnot. This
Yeah.
is, one of the most rapid drops we've seen. And, I guess it's a
Right.
V-shaped recovery because we're
Sure.
through it. But I mean,
Yeah.
that also defied what we've seen before. A lot of bear markets take, 500 days. And this is,
Yeah.
a fraction of that. So I think that
Right.
that is a
Yeah.
big piece of that.
I agree.
Um, Next question is, what are the benefits of buying an option in the money as opposed to out of the money? What are the downsides? So I think it'd be completely fair to talk about options on futures in this context.
Sure. Yeah, of course. So uh, there's a couple things to keep in mind when you're buying and selling options that are in the money as opposed to out of the money. On the futures side of things, I'm going to talk about that. Stocks might be a little different,
Hmm.
but on futures, the liquidity starts to dry up if you're getting deeper in the money. So you want to be careful with that. You don't want to be trading an option that nobody else is trading. And I will say that over the last several years, market makers have gotten much better at accepting orders. So
Yep.
even if you don't see a bid and ask on your option because it's deep in the money, if you put a fair price in, they'll usually take it, a reasonable price,
Right.
not something that's fair slanted to you, but a reasonable price that they take it. So, but it is important to keep in mind liquidity becomes an issue with in the money options if they're deep in the money. Also, but the point is, the reason people like to do that is their delta is higher. So if
Right.
they're correct in the market direction, the option will move more in their favor than it would if they were using an out of the money option. So it's a little riskier in that regard, and they're obviously going to be a little more expensive because they have intrinsic and extrinsic value. But the advantage is you're looking for a little more action. And if that's what you're looking for, that's where you'll get it. Me personally, I'm more of a fan of out of the money option spreads, but everybody has a different personality. And it depends on also what you're trying to achieve, what your signal is, what your goal is, what your time
Right.
horizon is. So everybody has a different idea on how to go about it.
Yeah, it's interesting you say that, because the other thing I like to, talk to people about with in the money options, I like to trade diagonals, and
Mhm.
I like to go to a really high delta, 80 plus. And
Okay.
one of the other benefits I find with that is just lower extrinsic value. If you're buying an option, I'm paying less for it. I would
Right.
love to hear your thoughts on why you prefer out of the money options, because that's obviously a different
Sure.
perspective than I have, and I love bringing those to the
Yeah.
table.
And you're if you're trading deltas of 80s and you're going pretty well in the money, the nice thing that you're experiencing is you have limited risk if all heck breaks loose.
Right.
Even though it's probably pretty big risk, it's still limited, and you don't have to worry about getting stopped out. And if you were trading a futures contract, you'd have to worry about stops probably. And you're not going to experience time value erosion. So those are the benefits that you're going to get. The reason I like to go out a little out of the money is I'm cheap. So
Fair.
most of the time when we recommend a trade to our clients, it's usually something that's to be held for weeks, not days,
Right.
right? Maybe even months. And so we're a little worried about time value erosion, which is why we use spreads, so vertical spreads or
Right.
butterfly spreads, things like that. And also we're just looking to keep our risk low, because if we're wrong, we'd rather lose $500-600 as opposed to 2-3 grand.
Right.
So
Yeah, I think that
um,
makes a lot of sense. And I think that resonates with a lot of folks, because most of the people I talk to that like to buy options, they essentially go out of the money for that exact reason. It's cheaper.
yeah,
And
sure.
I absolutely think there's something to be said for it.
Yeah, it's
Um,
I found it's a personality thing, honestly. If you're
yeah,
you really honestly, there's no right or wrong way to do it, except for if you're hopefully making money and not losing, that's obviously right or wrong. But the real thing is it's a mental game. So if you're trading a strategy you're uncomfortable with, like if you're spending 2 grand on an in the money option, but that you can't sleep at night, you're probably going to make bad decisions. So it really boils down to just do what you're comfortable with. That way, hopefully you're making good decisions along the way.
yeah, I love that you said that. I kind of beat the same drum of, if you're like stressed out about your portfolio, it's probably because you're
It's
doing something you shouldn't be. You either
sure.
don't have a plan for what you have on, or not comfortable with how you're going to manage it. So I
Right.
think it's interesting that you bring that up. You could just tell that it's something that
Yeah,
also, you've seen, which is good.
of course.
Um, so something that is I guess a great segue from what we are just talking about is, you're talking about spreads. What are some of your favorite strategies and why?
Okay, so it depends on market conditions and what's going on. In the current market condition, we found that, like for example, let's take metals. The
Hmm.
metals are just all over the place wild. So anybody that's trading full size futures better have a steel stomach, because it's just not, you know what I mean? Or they
Yeah,
they better have a big account, or they just all these other things. So what we've been encouraging people to do is to trade butterflies. Now it's not
got it.
perfect, because I mean, if you've ever traded a butterfly, you know, if you're too right and the market surpasses your profit zone, you're out of
Yep.
luck. So that's frustrating. You kind of get trapped into the trade because you have to get most of the profit out, you need to wait to expiration. So
Hmm.
sometimes that's an issue too. So it's not a perfect game, but you can get into, like, for example, gold and silver butterflies with 30 days to expiration, for risk of $500 or $600 and a profit playground of like $5,000-6,000. So there's some pretty big payouts. It takes some luck and it takes some skill, and there's all kinds of things
Sure.
going on, but it's a way for a smaller trader or someone that's risk averse to get into the market. So we've been
Yeah.
pushing people towards that sort of thing, because the first thing a new trader talks to me about is gold and silver, and I try to explain to them, well, you know, that's probably not the market you want to trade for your first time,
Yeah.
unless
Gold,
maybe
two
you
hundred
go this
thousand dollars
direction.
notional.
Yeah,
Yeah.
Yeah, it's brutal for a beginning trader
Yep.
that's trying to learn. So we've been kind of pushing them that way, and hasn't always worked out. I mean, it's a volatile market, but at least they're learning, and their risk is very small and limited. So
Yeah, yeah. So when you're looking to set up your butterflies, do you have like
mm.
a, I don't know, like a standard setup that you like, or how do you assess what kind of butterfly you want to put on?
So like for example, in silver, we try to keep the wings about $1.50, maybe even if on a good volatile day, we can get $2 spreads. So
Yep.
it'll basically give you a $4 range in silver. You could, if you silver lands in that $4 range, your trade pays something off. So that's a pretty decent, I mean, 2019 silver, $4 would have seemed like, massive. In
Yep.
2020, $4 in silver isn't as much, but it's still a nice range and gives people pretty decent odds of getting something out of it. Similarly, earlier this year, we could do the same thing in crude oil. We were doing $10 spreads in crudes. So meaning,
Wow.
I'm trying to remember when crude was in the dumps, we had some trades on where we bought the $30 call,
Hmm.
sold two 35 calls, and then bought a 40 call. So we had a $10 range in crude oil,
Yeah.
and I think we only paid $500 or $600 to get in. So those kinds of things every once in a while when the market's volatile are really good opportunities.
Yeah, it's funny that you bring that up because when I was watching crude oil as it was making its decline, I didn't touch it because with the futures market, I don't know, I've probably been trading in there for maybe 4 years now. Definitely
Hmm.
far less tenured than just regular options on equities. And crude oil, it freaks me out because sometimes it seems like you think you know what's going on. We get the
Right.
inventory reports, and then all of a sudden something comes from across the pond that just changes everything. OPEC comes out with
Sure.
some new whatever guidance on what they're going to produce. Do you? I don't know. I'm curious how you manage that because it's something that
Yeah.
I still haven't quite figured out what I like to do in there.
Oil is a really, really tough market, which is
Yeah.
unfortunate because that's what most people want to trade when they trade commodities. But I can tell you, I've been doing this for a long time, and crude oil 2020 was something I wish I had never seen, and I hope I never see it again. It was literally a nightmare. Like it was bad. We had we had a lot of clients that had short options, and some of them were trades that we had recommended, and we had you probably don't remember this, but it was in March, like early March. The market settled at, I'm kind of, I don't know exactly. I think it settled at like $42 a barrel on a
Yep.
Friday afternoon. And then when it opened back up, it was in like the low 30s.
Yep. I'm looking at it right
And
now.
so going into that weekend, we had some put spreads on. They were short option put spreads, and we purchased bear put spreads to hedge it. And we had like a 3% hedge, thinking we only needed to hedge ourselves to Monday, and then we were going to kind of restructure and
Right.
see what happened. Well, that 3% was like nothing because the market gapped lower
Yeah.
and just completely blew up our spreads. I mean, it was nasty. And then we had a handful of clients that were, because we're a brokerage, our clients do whatever they want. It's not like
Right.
you know, they're trading online, they're making their own decisions. We had a lot of clients that were short naked puts, and I felt really sorry for them because it was just, I
Were,
mean, it
were you
was
guys having
ugly.
to liquidate folks or?
Yes. So I would actually had to be,
That's
I would
brutal.
happen to be in New York for the money show. It was like just bad timing as well. So I was like in New York working from a remote office, and for about 40, I want to say about 42 hours straight, no sleeping, no eating, just sitting in front of a
Oh
computer
my
helping
God.
people liquidate their trades. Yeah, it was brutal. It was,
That
the,
sounds
it
miserable.
was horrible. It was really, really a tough couple of days, but um, yeah. So it
Yeah,
is what it is.
it reminds me of obviously not to the same degree, but there was I forgot the name of the fund, but they were shorting VIX futures, and it was a couple of years ago, and they got
I
blown up.
remember that. I
Yeah,
remember that. Yeah.
yeah.
Yeah, it's too bad.
And that move right there is exactly why I'm scared of crude oil.
Yeah.
For stuff like
Well,
that, it freaks
you
me
should
out.
be. And that's what solidified my thought. You know what? Naked options never again. Never. And we had even had hedges in place. It's not like we were completely naked, but
Right,
it just didn't do any good. And also in a situation like that where the market's just out of control, the bid ask spreads are wide. So
right.
even if like even on your long puts to sell, just try to sell them, you're getting hit for $200-300 in and out. I mean, it was just a mess.
Yeah,
But
that's actually something I always talk about when trading, in the money options, is the fact
mhm.
that, a lot of folks will kind of force their way into a trade, and it's like, you got to get out.
Yeah,
Like there's another
yep,
piece to this. And
sure.
yeah, it's as soon as volatility starts expanding, it becomes
Yeah,
a bit of an endeavor.
it is.
What do you
Yeah.
think about that move? I'm looking at the chart. I haven't really analyzed it before, but like you were talking about, it was, in the beginning of March, it looked like it hit a high of 48.66. This is
Mhm.
crude oil futures, light sweet.
Yep.
And towards the end of April, it hit a low of $6.50. That seems just insane to me. I'm curious how that stacks up. I don't follow
Yeah.
crude oil that closely, so curious what your thoughts are on that move.
Um, Insane's a good word. I mean, that was just off the charts stupid. It happened. I don't know if you're familiar with the ETF USO.
Yeah,
Honestly, what happened is USO blew up and it just kind of took everything down with it.
interesting.
Because USO it's an ETF, it takes investor money and then uses that to buy futures.
Right.
And they started buying only the front month futures, which at the time was May.
Yeah.
And the May contract just went into free fall. That's the one you probably heard on the news or whatever. Crude went to -40.
Yeah.
It was the May contract. Honestly, that's kind of fake news. It was only a handful of contracts that traded down there. The May
Right.
contract was going into expiration, so it's not like everybody, it was kind of fake news. But
Right.
they made a big deal about it. But the reality is the next contract, the June contract, did get under $10 because of all that liquidation that had to come. Because as you can imagine, margin calls and all
Yeah.
kinds of crazy stuff going on, and the ETF blowing up, and
I
um,
didn't I didn't realize that the ETF was one of the major contributors to that issue.
Um, I mean, it started with the original sell-off in March started with coronavirus, and then
Mm.
soon after the early March, the gap that I was telling you about, that was OPEC and Russia got into a stalemate,
Yeah.
and then there was like a production war, a price war. Then on top of that, USO started blowing up, and honestly, this is just kind of my opinion. It's not, there's no documentation to support this, but I would venture to say if it wasn't for USO blowing up, we probably would have never printed below maybe 25, 23 in crude oil.
Yeah.
But that ETF just got really big and a lot of speculator money came in. And what happened is everybody knew that crude oil in the past, every time it got down to $30, it was a huge buy. Happened
Right.
in like 2009 or whatever it was. So it's happened a couple of times. So all of these speculators, kind of like what we're seeing in Tesla, people
Oh my
that with
God.
their Robinhood app, all
Yeah.
these people that have never traded before decided, hey, oil's cheap, I'm going to buy USO. And then when it went the wrong way, it just got ugly and cascaded, and that was that.
Yeah. Yeah, that's interesting, especially
Yeah.
because when I talk to folks about, ETFs and ETNs that track with futures, they always
Mhm.
suffer a ton of drag. So
Yeah,
I don't like to hold them long term anyways, but it's
sure.
interesting that so many folks were kind of buying into positions there. I really didn't know that.
It was a lot of rookies,
Yeah,
a
oh,
lot
I
of rookies
bet.
buying USO, and honestly, a lot of rookies buying futures. Because now, it used to be when I first started in this business, not everybody could trade futures,
Right.
or people didn't think they could, and took a little bit of work to open an account and so on and so forth. Well, now all the stockbrokers offer futures on the side. It's not what they
Right.
do, but they do offer it. And so what ends up happening is people that literally have no idea what they're doing have access to these products. And so there were a lot of traders that thought oil couldn't go below zero. So
Right.
for example, I read some articles about I'm not going to mention brokerages
Sure.
names, but stock brokerages where their online traders thought, well, crude's at $5, I'm going to go ahead and buy a whole bunch of it because it can't get lower than zero, right?
Right.
And so they got that sort of thing going on, and that also exacerbated the losses.
Yeah, that's pretty interesting. I
Yeah.
I don't know. When I look at all the, the new folks coming in the market, I'm always stoked that there's people that are figuring it out, but it also is, I don't know.
Yeah, it
It's the
goes
same
both ways.
with Hertz, right? The
Yeah,
company declares bankruptcy, and then all of
right.
a sudden they get enough investment that they're talking about, sending out a round of debt. It's just like, what? You just declared
Yeah,
bankruptcy. But yeah,
it's weird. It's crazy. Yeah.
yeah, I find that to be a bit of a trick. Now, dovetailing off of some of your favorite strategies, I think you probably mentioned it a couple times in passing, but what are your least favorite strategies and why? I assume it has something to do with naked options.
Um, well, I mean, naked options is probably one of them at the moment, just because of what we've talked about. But I'm
Yeah.
not a big fan of. A lot of people want to buy or sell futures and place a tight stop because in their mind they're thinking,
Mm,
my stop's tight. There's not very much risk, and I have all this profit potential. But the reality is, they're bound to get stopped out. Like
just
the
gonna
odds
get
of them
stopped out. Yeah.
actually making money are slim. So they may only lose $100 or 200 or whatever it is they're risking on that trade, but they're probably going to lose that on like 20 trades in a row.
Right.
So, and I see that all the time. And I try to encourage people to, if you can't afford to have a deep stop, trade a mini or a micro, trade a
Right.
smaller product, or use an option to hedge. Sometimes that's a good solution depending on the market if the options aren't crazy expensive. But stop orders are, I know they're meant to protect people, but I feel like they probably do more harm than good in many cases if they're not used
Yeah.
right. So,
Yeah. I think I talk about, I don't know what it is in the options world. Everybody wants to talk about probability of profit and win rate and stuff like that. And I always tell
yeah,
folks, like, you're focusing on the wrong thing. Like, expectancy is what matters. Like,
sure.
what does this system return? Because you can have something that 95% right, but the losses can be so massive that it doesn't matter. It's a
Right,
losing
right.
strategy. So, one of the things I'm curious about when we're kind of talking about those stops and whatnot, what kind of, let's say if you're trading gold or silver, the futures, what kind of stop would you like to put in those?
I mean, me personally, my personality does not work with futures trading. I get stressed out, so it's not for me. So I'm not the right person to answer that. I mean, I would say generally I prefer to not have stops. I know that sounds crazy.
Yeah,
People are going to think I'm nuts for saying that, but so I would say if you want to trade gold futures, rather than buying a full size contract and placing a stop, just buy the micro. The micro is probably not going to ruin your life in a couple days, even as volatile as it's been.
right.
You probably survive the volatility, or at least, I mean, you can have mental stops, and hopefully you're capable of sticking to those. Or, but especially in this type of volatility, stops are they're going to get hit at the worst time. And then the most frustrating thing is your stop gets hit, but the market's moving without you the way you thought it was going to go. So
Yep.
then you chase it, and then it becomes this big cycle of never-ending losses. So
I'm really glad that you mentioned that because it's one of
yeah.
my disdains for stops. I avoid them at all costs because I also do absolutely believe that there's, predatory pricing. Folks can see resting orders and whatnot, and I have,
Mhm.
no illusions that markets don't move towards some of those higher levels. So one of the things that you mentioned is the micros and the minis, and those are relatively new based on what I've seen, especially in terms of their liquidity. Do you want to talk about what you think about them and kind of their place
Sure.
in the market? Because I've been blown away with how efficient they've been. I thought for sure folks weren't going to flock to them, and when I take a look at them, I'm like, okay, like there's
Yeah.
actually like plenty of volume here.
There is. There's definitely enough liquidity. Now, I try to encourage people, like, well, let's start with which products have it. Not
Yeah,
all futures markets have minis or micros. The E-mini S&P used to be, believe it or not, there used to be, well, there actually still is, but nobody trades it. There's a full-size S&P, which is crazy big, $250 a point, trades open outcry, nobody trades it anymore. So the mini used to be the mini, but now there's a micro for the E-mini
right.
S&P for the stock indices, which is 1/10 the size of the mini. So you're making or losing $5 a point, and it's insanely liquid. So
Yeah.
that's a great product. But what most people don't understand is gold also has a micro contract, which
Yep.
is 1/10 the size of the regular gold, which is a great product. There's a mini corn, a mini soybean, and a mini wheat, which are also really great because people can simply, I mean, even small traders can just put on a position and hold it. Like, for example, uh, grains generally make lows during harvest time in October. So if
Right.
you're a small trader, you might want to think about just going long corn and soybeans in the fall and hoping that what happens most years happens this year. So
Right.
it's a really great way to get in the market without having to worry about the daily ebb and flow. It's a long-term position. And there are microcurrencies also that people aren't aware of, and those are really great products. The great thing about them is you can use them for position trading, so you can spread your time horizon much wider than you would if you were trading a full-size futures because
Right.
of the leverage and the risk. But the other great thing is you can, like, I talk to people all the time that paper trade for years, like for
Right.
a decade they'll paper trade and they think that they're helping themselves, but they're really not. Paper trading is good to get familiar with the products and the platforms, but beyond that, it's not that helpful because
Right.
it removes emotions. The micros and the minis are a great way to kind of take one step out of the box. And it's not paper trading, it's real trading because there's money on the line, but it's not enough money to ruin your life.
Right.
So it's kind of the best of both worlds. And so I encourage people to start there.
Yeah.
And rather than paper trading for 10 years, start with a micro and see how it goes.
Right. Yeah. I think that
Yeah.
that's a new thing that I truly think benefits the market a ton for that exact reason. Because I know when I first started trading futures, I was absolutely super nervous because
Yeah.
just big position. And
Yeah.
when it's your first time stepping into it, it can be a little bit weird. Whereas now I'm kind of used to, the size, and then these come out obviously. And I'm like,
Right.
well, that's really good for a lot of folks.
Mm-hmm.
When you're, talking to folks about potentially starting with the minis and in the micros, do you still talk to them about hedging as well? Or do you typically say, this is a small enough product in general that I
Right.
would stay away from the hedges?
In general, we generally kind of stay away from hedges because, for example, mini grains don't move very quickly at all. The margin's less than 500, and
Yeah.
you'd probably do more harm than good trying to hedge
Yep.
them with an option. The same with the microcurrencies. I think that's about the same. Now, the interesting thing is that we're having this conversation in the the E-micro S&P. They've listed options against the micro today on the
Mm.
CME. They just started trading this morning. Uh, Liquidity it's still a little questionable, but that's
Yep.
because most brokerage firms don't have it on the platform yet because it just started today. But I expect within a week or two, those will be firing on all cylinders. The market makers were keeping the spreads nice, so there will be hedging opportunities in the micro S&P very
Interesting.
soon. So yeah, it's going to be interesting. I'm excited to see how it goes.
Yeah, that's actually fascinating. I didn't know that. That's another
Yeah,
good pickup. Because I don't know. I don't follow the minis and or the micros that closely, but
sure.
I think that they're a great product. So that's interesting that they're starting
They are.
options on
I
them.
should just add one thing I forgot to mention.
Yeah.
While I encourage people to trade the micros and the minis because of the small size, I also encourage them to look at the chart of the full size contract. So, for
Mm.
example, if you're trading the micro gold, just go ahead and look at the full size gold contract because there's more liquidity. The charts are going to be a little more efficient when it comes to indicators and things like that.
Yeah, it's funny you say that because one of the things I talk to a lot of folks about is, even if you're trading the SPY or other index ETFs, you should be looking at, /ES or, whatever
Sure.
version of the E-minis you have, just because there's
Yeah.
so much leverage and volume in those. That's what's going to move the
Right.
market. Yeah.
Yep. Absolutely.
So next question is, what drew you to commodities?
I mean, it honestly just pure luck. I just stumbled into it. That was it. I didn't know anything about commodities until I started on day one. So
So pure
it
luck.
is.
Yeah. So then I guess a good follow-on question to that is, what's kept you with commodities?
This is an easy industry to fall in love with because it's something
Mm.
different every day. It's not a 9 to 5. Now, I will tell you the hours are really long because futures
Yeah.
markets never close.
Right.
And I never get a day off really. Like people think because I travel a lot for work, but I'm still working. Like I
Right.
still set up an office and work wherever I am. So even
Yep.
if I'm traveling, I'm working, but that's okay because I love it and
Yeah.
it's not boring and I'm excited to work every day. Um, I will tell you there are some horrific days like the crude oil in March, like I
Yep.
mentioned. Sometimes it's just not fun, but um, I mean it's exciting and so it's keeps me coming back for more. When it stops being fun, then I'll be done, but that hasn't come yet.
One of the questions I have for you personally is, when I first started trading futures, I was always hesitant to break into different commodities because I felt like I needed to know everything about them, their life cycle, the reports that come out and stuff like
Right.
that. What do you give that any credence? Or, if somebody wanted to approach something like wheat or corn or
Hmm.
soybeans or hogs, whatever, do
Sure.
you do you think that they should take the time to dig into all of that stuff, or how do you think they should get started on those kind of things?
I mean, I guess it depends on what their strategy is. Like if they're, for me personally, I look at charts. I look
Okay.
at technical analysis. I look at the COT report, which is basically a report that the CFTC issues that tells us who's long
Right.
and who's short and how much. I look at seasonals. I do glance at fundamentals, which are all the things that you're talking about, but I probably don't wouldn't make trading decisions solely on fundamentals. So
Right.
my personal opinion is you really want to be familiar with that kind of
Yeah.
stuff, the basics like harvest cycle. But I wouldn't say you need to be dissecting every data point, because the reality is, especially in commodities, the data is slow. So like if we're
Hmm.
looking at numbers, you know, in a report that was released today, that's probably was gathered weeks ago or maybe even a
Right.
month ago. So it's not necessarily current. And even if, let's say that we predict what the next report's going to say, that doesn't mean the market's going to react that way.
Right.
I mean, sometimes a bullish report comes out in corn and the market tanks. So you just never know. It's
Yeah.
just,
It's the market keeping
yeah,
everybody on their toes. It seems like that's
exactly.
always the case.
Right.
Yeah, it's good to hear you say that, because I really felt uncomfortable when I was first starting, because I didn't understand even the basics of some of these products, and I was like, you know what,
Right.
like like you're talking about the harvest cycle, like that is a
Mm,
clear thing that you should probably understand to make sure you stay out of the way of positioning
sure.
yourself in a weak position. So I'm glad that
Mhm.
you bring that up. Another question is, how do you approach trading during election years?
So prior to 2016, I probably would have said, other than the stock market, I don't think there's going to be, who's in the White House isn't going to make a huge impact on commodities.
Right.
But that thinking has been completely thrown out the window the last 4 years. So because I mean, with all the stuff going on with China and U.S.
Right.
trade deals, it's absolutely impacted commodity prices, and so suddenly it is a big deal. I don't know if I would necessarily change anything that we do, other than we already mentioned. I selling naked options is just not a good idea. For example, in I want to say 2018-ish, when the whole China trade deal started out, anyone that had naked options in any of the grains were probably just completely washed out,
Hmm.
because suddenly politics is playing a big part in commodities, which wasn't really the case before. So again, other than just making sure you have hedges and insurance in place in case a tweet comes out or something that's unexpected occurs, um, I wouldn't change anything other than making sure there's insurance in place, if that answers it.
Yeah.
Yeah,
Yeah. I think for me, the way that I've been viewing it is the beginning of the year and whatnot, I've kind of maintained my normal allocation. But as we get closer and closer to September, I've just been slowly pulling risk off the table. And I mean,
sure.
I'll maintain exposure definitely in general positions, but I will have little exposure myself. I just the fact is, for my paradigm, when these events come up, I feel like it's exactly like you were mentioning, with some of the reports, and then the market just goes the other way. I keep talking about how emotional the market seems, and I don't feel comfortable with a lot
Right,
of the reactions. It just seems so overdone, so emotional
right.
that yeah, for me, I'll probably be pulling risk off going into the election. Um, so you've been talking a lot about hedging, which ties great to the next question, which is, what is your preferred method to manage tail risk?
So, sorry.
No, it's okay.
I apologize. Um, Probably the best way to manage tail risk is the purchase of catastrophic insurance. And so, what
Mhm.
I mean by that is, in the great thing about options on futures is most of the markets have expirations, not just every month like it used to be. A
Right.
lot of them have weekly options. Now, some of the liquidity is hit or miss in some of them, so you have to be careful, but there's generally opportunities to hedge at any time, and you can pinpoint your hedge. So you're like, if you're, let's say, for example, there's an event risk coming up, OPEC meeting, let's say,
Sure.
and you have a crude oil position on, and you want to hedge that meeting, you might only need your insurance in place for the next 2 or 3 days.
Hmm.
There's an option that you can purchase that will get you exactly that exposure, and you can buy them cheap usually. Right now, really cheap because the market's quiet. I mean, maybe $200-300 to hedge your risk going into an OPEC meeting. Before weekly options were in existence, you would have to buy an option that expired in a
Right.
month, and you might have to spend a couple grand. And if the market went the other way, your insurance would just go up in smoke. And so it's a lot easier to do that now. And when I say catastrophic insurance, I'm saying purchasing cheap options. You don't want to spend a fortune, but maybe
Yeah.
200 or $300 just to take away the risk of that out of the ordinary event occurring. And a lot of people ask me, because I talk about this a lot at the Money Show and things like that, and they
Yeah.
say, but if you're spending $200 on an option, how is that ever going to pay off even if something happens? That you would be really shocked at just how explosive those options can be. I mean, if you buy a $200 option, most of the time it's going to expire worthless, but
Right.
that's the point of
Right.
insurance. Um, but when it does pay off, it can be pretty spectacular. That $200 option can be 2 or 3,000 pretty quickly. And
Yeah.
I mean, in a big move, not on a normal move. But if that
Sure.
truly is what you're hedging is tail risk, it works.
And I don't know, the other thing I talk to folks about hedging is the fact that, I mean, you already hit part of it, is that you want your hedge to lose. You don't want that
Yes,
position to win. You want your base
right.
position to win. And then the second thing is, I always talk about under hedging. So your hedge might pay out, but again, I would never want my hedge to pay more than my position, because
Sure,
then I'm kind of set up for failure. I have a different base position. My head's my base,
right.
base position. So when you're structuring some of these hedges, what are some things that you look for? You mentioned, out of the
Mhm.
money options. Do you like to balance delta, or what's your approach to that?
So it really, again, depends on the situation and where we think the risk might come in and that sort of thing. I definitely always look at a chart. So
Right.
um, I look at support and resistance, and I
Got
don't
it.
need my hedge to come in before support or resistance. I need it to
Got
come
it.
in after. So we do that a lot. We also, and you're right, the hedge is, I try to explain this to people. Basically, you have a position that you are speculating on, that's your money maker. And then
Right.
anything that you trade around that is a hedge. And you ideally actually want to lose money on your hedge because that
Yep.
means hopefully your money maker is making money. People have a hard time with that, but
Yep.
that's in reality, that's exactly what you're doing. But one thing I also try to encourage people to do is if you are hedging and it does pay off, make sure you lock some of it in,
Mm.
because usually, for example, like if we're doing portfolio hedging, let's say, actually, this is a good example because the S&P is really expensive. So you can, at the moment, put on a portfolio hedge where you sell a call option above the market, and then you use the proceeds for that to purchase a put. You
Right.
basically have free insurance on your portfolio of roughly, if you're doing an E-mini S&P, it's roughly 250,000, 275, whatever it is at the
Right.
moment. So you're hedging that much of your portfolio for free. But what I find is a lot of people will, even if they put the hedge on, and let's say miraculously the market just cracks and we trade down to 3,100 or 3,000, most people fail to ever take a profit on their hedge. And so it's almost like they might as well have not had it in the first place because the
Right.
market rebounds. And then now, if you're doing a free insurance, like what we were just talked about, that's not such a big deal because it was free
Sure.
insurance. But you are giving up your upside if the market sells off and then rallies sharply back and suddenly it goes above your short call strike price, then you're giving up your gains above that. So there is
Yeah.
some opportunity cost, but hedges you generally want to take profits on if they pay out, and then
Yep.
maybe reestablish a new hedge with less, a new smaller hedge, I should say, so
Yeah.
that that way, if the market rebounds, you're not giving all the money you just made back. Otherwise, you just paid commission or whatever you paid for no reason, and you're not any better off.
Yeah, it's good that you mentioned that as well, because one of the things I talk to folks about a lot is at least setting some sort of P&L target on a trade. Just, what the hell
Sure.
you're looking for. It doesn't
Right.
necessarily mean you have to stick to it religiously, but you at least have something that you're targeting. And
Hmm.
one of the things I see folks talk about is hedging, but they don't set that profit target or loss target
Right.
on a hedge. Most hedges, if you're long an option, I
Sure.
imagine most folks would just let it go to expiration, expire worthless. But
Exactly.
setting that profit target, I think, is really smart. Do you have any? I don't know. Do you
Yeah.
have any guidelines for what you would consider profit taking zones for a hedge?
Me personally, I don't really look at the profit on the option. Although if
Okay.
there is a big profit there, it catches my eye, and then
Sure.
I would say maybe it's time to maybe it's time to
Yeah.
do something. But I would look at the chart. So for example,
Got it.
in today's S&P, if I think a correction could see 3,100, 3,000, if we got down to that vicinity, I would say maybe it's time to take the hedge off.
Understood.
Um, I should have mentioned I did a bad example. I talked about selling a call and buying a put, which is actually a very good way to hedge a portfolio. But what most people do is they don't sell the call; they
Right.
just buy
Buy
puts,
the put. Yep.
and they end up spending all kinds of money. Like if you bought
Mm-hmm.
a put for every, let's say every quarter, you'd probably burn 6 to 8% of your portfolio every
Yep.
year just protecting it. So if you did that, but the correction came, you never sold your put, not only did you burn 6 or 8% of your portfolio, but then you never benefited even when it
Right.
did what it was supposed to do. So anyway, I should have used that as an example instead. But I look at the chart, not necessarily the P&L on the option.
Yeah, I absolutely love that,
Yep.
because when I'm looking at most of my profit taking, especially if it's a swing position or, something I'm keeping on for a few weeks, I always like to see if it made the move I thought it would. And
Sure.
that's generally my approach there. So it's good to hear you
Makes
say
sense.
that. Another question, this is one that I really like, is are there any pairs trades that you frequent or kind of keep an eye on?
To be honest, not really. No, it's just
Is
not something that we have focused on. I mean, we do
Got it.
look at a lot of intermarket correlations, but not necessarily to trade them, just to
Structuring.
kind of,
Got it.
yeah, just kind of make guesses on what the next move might be.
Yeah, interesting. Because that's actually how I got into futures, was starting with pairs trades. But
Oh, cool.
the thing I think a lot of folks misunderstand is, when you're trading a pairs trade, or the relationship between two products, there's nothing that ties that relationship. So you
Right.
can be wrong on both.
Sure.
I've talked to some folks before, and they think it's like a hedge position where if one
Sure.
goes this way, the other one should move. And like, I can't tell you how many times where they both
Yeah.
just don't agree with you. So
Right.
yeah,
No, you're absolutely right. Yeah.
I've learned that pairs trading, typically I'll throw a hedge on with it, and it blows a lot of people's minds. And I literally just show them examples where things don't move the way
Yeah.
you think they would.
Right.
So we got two more questions, being mindful of your time.
Mhm.
The first one is, do you have any recommendations for traders that are starting off, so kind of new traders that want to get into futures?
Yeah, sure. So, I mean, the first thing is do your homework, start with the basics. This is going to sound like a shameless plug, but it's actually, I am trying to help people with this. So, I've written a handful of
Please.
books.
Yeah.
The book that any beginning trader should start with, it's called A Trader's First Book on Commodities. You can get it on Kindle for like $2.99, so it's not
Awesome.
expensive. Or the hard copies, I think, $17 on Amazon. Anyways,
Sure.
the point is, it's not sexy or exciting. It's boring stuff. Like, you're going to learn about how to calculate profit and loss. I know your platform does that for you nowadays, but it's still, you really, really should know those basic
Yeah.
things before you put a trade on. So it talks about just everything that you need to know before you actually think about trading. And then maybe after you read it, you might decide, you know what, commodities aren't for me, or
Right.
maybe you will. And because it's really good at just not only explaining from ground zero the basics, but also explaining that speculation, there's no guarantees you're going to make money. Most people lose, and all those sorts of things. So it's a good way to to test the waters to make sure it's even for you before you get started.
Yeah, I love that. And
Yeah,
that's really the point of these conversations, is to tie people to resources like that if they're interested. So I appreciate
sure.
you bringing it up. Is there any recommendations that you would have for seasoned traders that want to get into futures, or is it kind of the same approach, would you say?
Well, I would say if you're a seasoned stock trader and you're looking at getting into futures, I honestly recommend the same book, because
Yeah,
you have to know the basics before jumping in. Because I mean, the whole point is, like, we're a brokerage service. We make money if people trade commodities with us, but
right,
we don't want people to come in and trade and not know what they're like. We don't want them to
right.
lose their hard-earned money because and I'm not saying they won't anyway. Even if they do all their homework, they still might
Sure.
wrong or lose money, but at least they know what they're doing, and it won't be like crash and burn
Yeah,
day one. Because really, the smallest mistake can be, for example, let me just give you an example.
yeah.
A lot of people they don't, they're not aware of the fact that different commodities sometimes trade on different exchanges. So, for
Mm,
example, some of the softs are listed on ICE, but they're also
right,
listed on CME. But all the liquidity is on the ICE products, and nothing's on the CME products. So some people accidentally get into the wrong coffee or the wrong sugar, and they can't get out because there's no liquidity. So just
right.
things like that that are so avoidable, but people
You don't know
fall
what you
into
don't
those
know.
traps. Yeah, you
Yeah,
don't know what you don't know. So I really, ground zero is the only place to start, and then go from there.
I love that. And I guess the last question I would have for you is, are there any products that you would recommend people to start with? I had a few that folks recommended to me, but I'm curious what your thoughts are on that.
So if you're just getting into futures trading, I think the micro S&P is a great way to start,
Yeah.
because most people are familiar with the S&P 500. You don't have
Yep.
to learn anything new, and that'll give you just a handle on how the leverage works. and the 23-hour marketplace, which is
Yep.
different. I mean, people aren't used to that. They think they can sleep comfortably at night and then, wake up to a fresh day. But in
Right.
futures, I mean, in all reality, and stocks are changing values throughout the day, even though the market's closed. But in futures, it's a little more obvious because you can pull it up
Yeah.
your phone and see it, and it bothers some people. Some people aren't used to it. It takes some getting used to. So I think that's a really great place to start. Also, the 10-year note is a great place for beginning traders because it's slower, the margin's lower, and they're also familiar with interest rates generally. The other thing I would recommend is corn. Corn
Yep.
is really, not always, I mean, but right at the moment, and the last several years, corn's been a pretty quiet market. Margins
Yep.
are low. You're probably not going to make or lose a ton of money, but it's a good place to get started.
That's exactly what folks recommended for
Yeah,
me was corn. So
perfect. It's a good
yeah,
one.
it's and I think that the micros now is actually just beautiful advice because now that they
Yes,
have, the smaller version of it, I do think that that's a great place to start. When I was
it
first
is.
starting, that didn't exist. So
Right. Yep, it's
it's
new.
kind of the thing that would just blow your
Yeah.
account out if you messed up.
Yeah.
Yeah.
Yes.
So I can't thank you enough for your time. Honestly, you're
Sure.
just wonderful to talk to. You have a ton of great
Well, thank you.
information. So on behalf of myself and all the folks that kind of send questions in and watch the videos, thank you
Yeah.
very much for hanging out for a
Yeah,
little bit,
of
and
course.
would absolutely love to pick your brain again in the future.
Yeah, we could do that. Thanks for having me. It was fun.
Yeah, awesome. Well, we will catch you next time.
Thanks.
Take care.